had the classes together. So at a very, very macro level, we talked about, kind of VC structures as a whole, and some of the key considerations, and then we'll talk a little bit more today about, kind of how VC funds are structured. So let me just skip past all this because you all had this class already. All right, so let's talk a little bit about the structure of a venture capital fund. So a venture capital fund is just like any other fund in many ways. So it is a big pile of money that a group of people called general partners are using to invest in things, and that money is provided by limited partners, LPs. So the GPs invest the money, the LPs provide the money and hold the GPs accountable for investing it. And the LPs are basically looking for the same thing that they would be looking for if they were investing in a hedge fund or in a private equity fund or an index fund. They're looking for some type of a return that maximizes their return based on their current risk of their portfolio. Oftentimes, the people who are investing this will not just be investing in venture capital. They'll be investing in venture capital as well as sometimes numerous hedge funds, some that are currency focused, some that are growth focused, some that are options on farming focused, bond focused, fixed income, that is. You can have them very heavily in real estate. I mean, really just the whole gambit, right? But you're looking at a few types of places where these funds come from. So a lot of times they're coming from pension funds. So pension funds are basically, think about a very large company like a Daimler, HPE, for example, huge companies in the world. They will have pension funds that they are using to provide pensions, that is retirements, for the people who work at those companies. Endowments. So, for example, Call of Duty, right? Maybe you guys know the company Activision. They make the video game Call of Duty. Well, Call of Duty has an endowment. HPE has an endowment. The HPE Foundation. You have Yale University has a huge endowment. So does Harvard, Princeton, et cetera. These massive endowments, and they're spending a lot of time looking for investments that they can maximize and grow that endowment over time. Wealthy families. So if you think about like the Walton family in the United States, who runs Walmart, or founded Walmart, it's not ran by them really anymore. Then you have, still the heirs to the Bosch empire, and things like that. These folks who are really, really wealthy, high net worth individuals will have what are called private offices, family offices. And the family office is typically managed by an investment manager who is taking their assets and making sure that all their tax, all the way from their investments to the taxations, everything is optimized to lower the risk and maximize the return for their current strategy, whatever their strategy is. And so anyway, all these folks are typical types of people who become LPs, and you have others as well who kind of fall into this category. This is venture capital specific, right? This is not, we're not talking about angel investing and seed investing. You can be an angel investor. You could be an angel investor with as little as, say, $10,000, and you go around and you say, I have $10,000. I really want to spend some time working with startups, and I'm willing to lose every bit of this $10,000. And either I spend all $10,000 on one startup, or I spend some time meet other angel investors, and I'm willing to put in, say, $1,000 each time into as very, very small amounts into seeding an idea to just kind of bring it forward. That's a very, very, very low end of the spectrum example. Typically, seed and angel investments are much higher in the range of like 50,000 to 500,000 for those types of investments, and a lot of times, as we'll see in a moment, you could have a number of those investors who are working together at the same time. So these are the folks who are providing the capital, staged capital, that are going into a fund. So here, notice how it says Fund 1. A venture capital fund could have a number of funds. So they will raise a funding round. You'll often hear this in the news or see it on Twitter, where they'll say, Kleiner Perkins raised another $3 billion for their latest round, or for their latest fund, or this new startup venture fund just raised $100 million for their first round, for their first fund. And so what happens is, When you go on the roadshow and you talk to all the people in this top box and you say, I want to raise capital, I want to put it into an investment fund, you tell them what your thesis is, you tell them what your advantage is, how are you going to deliver on sourcing, growing, and exiting from ventures in order to maximize their returns, and you get enough people to, you convince enough people to write you checks. That all goes into this GP-led fund. But it's not that you're taking their $10 million and you're putting it over into your account. What you're basically saying is, I'm going to hold you accountable for when we need to invest up to this amount for this fund. But you are going to have to pay me this percentage of, which is called carry. So you're going to pay me a 2% management fee for basically keeping the lights on and doing all the work that we're doing to source and due diligence on and close deals. And then on exit, we're typically going to get 20% of whatever the exit is. So and that's actually written out here, right? So 2% annual management fees. So let's say we run we raise $1 billion. If we raise $1 billion, we're going to get how much? Exactly 2%. So $20 million. The $20 million will be our annual management fee. That's what we will basically pay all of ourselves to our own salaries, as well as keeping our everything, all the administration of this fund running. And then when we exit, let's say we do 10 exits and we go from 1 billion to 10 billion, right? Then we will get 20% of that profit. So the profit being 9 billion, so 10 minus 1, 9 times 20% would be 1.8 billion. So what we would have as a potential to win is all of our annual management fees for the time that it takes us that this fund is active, plus all the exit profits that we make. So as you can see, this is where venture capitalists typically are trying to make most of their money is on the 20% exit. It's not necessarily on the 2% management fee. The 2% management fee is really just keeping the lights on. And then they're very defined, kind of limited time. So these funds can be, that they have 2 years, 5 years to find and source all their deals. Because if you are one of the people in this top box, there's a time value to your money. You don't want to just hand over your capital or tie up your capital, because even if I'm not giving it to you, if I say I'm in for $10 million out of this $10 billion or $1 billion fund, I can't touch that 10 million. I can't put it somewhere else, because if you come and you're the investor and you say, hey, I need that $10 million now and I don't have to give, well, I'm probably going to wind up in a lawsuit. I'm definitely going to wind up in a lawsuit, and I'm definitely never going to be invited back to invest again. So point is, there's like a timestamp to say, kind of move your ass and do things. And so this, pension funds are only investing about 5% of their assets into venture funds. The rest of it's going into all kinds of other things. And so there's the investment phase and the growth and exit phase. Venture portfolios are going to, like we said, they're going to acquire. And there's typically like this third kind of scenario. So a third of the companies that they invest in, they pretty much assume are going to return zero, or they're going to lose some money on it, right? So there's going to be no return on investment. A third of them are going to have just a very average return on investment, and about two companies out of the portfolio will have outsized unicorn size return on investment, and that's the ones that's going to kind of pull everything up. So it's not a normal distribution, a normal Gaussian kind of distribution of returns. It's more of a power distribution where a few people or a few assets are pulling the entirety of the portfolio. And that's where it's really important for the GPs to have the experience behind this, so they can know what they're picking, so they can know what teams are looking at, so they can know whether or not their plans make sense, whether the product makes sense, there's product market fit, that they have a growth strategy in place, that the market timing is correct, that the financial capital markets are lined up correctly to value their investment and their exit along the way. All these things just have to line up. There's just so many things that have to line up for an investment to work. So a lot fail early, some fail later, and those that fail later, you want to fail. If you're going to fail, you want to fail quick. You don't want to fail super long into this, because you want to be able to go back and raise capital for your next idea, right? And in the venture world, it's not like, say, in corporate world, where if you fail in the corporate world, it can be career ending. In the venture world, it's kind of expected that from time to time you're gonna have you're gonna blow things up and create a crater. So 1% of those business plans are selected, and later investments as the firm succeeds. So if we're doing well, it's not, if we're a startup and we're doing well, it's not unlikely that a venture capital firm would come in and pour money and more money and follow on around. So from seed to angel to Series A to B, B to C to D, et cetera, that they're going to continue trying to acquire more and more pieces of the pie. And which is also good for you along the way as a founder, because even though you will be diluting some of your ownership along the way, your pieces of the pie will get smaller, but your pie is getting much bigger. So much bigger than you could ever do normally with your own capital. Okay, so that's pretty much that on this slide. Let's go to the next one. So let's look at how that typical portfolio kind of looks. So look at here, the dark green is percentage of cost and the light green is percentage of value. So the bottom line here is that, I mean, this is pretty straightforward. If you think about the multiple on invested capital as less than 1x, what we're basically saying here is that a small portion of your overall value for portfolio is driving the outsized amount of your overall cost. So where you're getting like a less than 1x return on your investment, that means you're losing money. Hopefully, that's a very small portion, like 3.8% of your overall portfolio value. But as we said before, a lot of times investors are expecting up to a third of their portfolio to just completely tank. But the point is that it is very costly, and you want to keep an eye on how much of your portfolio is driving how much of your overall cost. Because again, you've only got so much cost, you've only got so much fund to invest, you've only got so much annual management fee to be able to pay for yourself and to be able to kind of invest in yourself and to invest with these startups. So you have to, it's like a garden, you have to constantly look for where the weeds are, cut the weeds and pull those out and focusing on things that are growing. And then as you can see, go from 1x to 3x, these are returns on investment. So 1 to 3x, 3x to 6x, and so forth. And the greater than 10x, those that are delivering the greater than 10x return on investment, these are like very small portion of the overall portfolio, but they are the ones that drive all the return. And that's where what venture capitalists are constantly trying to figure out is which horse is going to be the one that's going to win, right? And which horses, what are those couple of investments that are going to really drive all the value? And if you look at the total sum, right, of all this, these are pretty good numbers, right? I mean, if you only have 3.8% of your overall portfolio that's actually losing, and the rest of them are delivering between 1x and 10x of return on investment, you're doing pretty well. Okay, so what does a pro forma statement kind of look like? So if we're a GP, a general partner, and we are going to some investors and we want to kind of show off, well, what does our pro formas look like? Well, how do we show them with those early failures, write-offs, and when we start getting our money back? So these are basically the categories of outcome. It starts on the very left end of the spectrum, early failure, to a complete write-off, to we're just getting our money back, to we have a successful exit, but it's low. And then there's a successful exit, but it's pretty good, and a successful exit, unicorn status. As you can see, we talked about this also in a previous class. Typically, share ownership is going to be around 20% of the overall portfolio. Of course, if there's exit, if it's a complete write-off or early failure, there is nothing to exit with. So that's why that's NA. But assuming that we still have skin in the game, it's going to be approximately 20% is usually what a VC is going to be looking for. So if in this hypothetical scenario, let's say we raised $300 million. So we had $300 million and we put we assume that about 5 million of that is just going to be early stage. It's cool. We got to try it. There's just too many people with great ideas that we can't pass on everything. So we have to try some things, but we know that some of them are going to fail. We know that there are also going to be some that we're going to invest in that are a little bit later, probably going to just be a write-off, and those are going to be reflected in a little bit larger of a number because this can take some more money, of course, to see if that thesis is going to play out. These are ones where there's not really an early signing indicator, but maybe we just don't see that there's product market fit. When we try to start scaling, we start seeing that it can't go from small medium enterprises to enterprise level customers, for example. and so we just won't be able to scale as much as we wanted to. Some of those we just might early on say, you know what, this is technologically, the technology is pretty cool. The market just isn't going to buy it on its own. It's only going to work if it's a part with some bigger partnership. So for example, let's say we write some software and we take it out into the world and we say, hey, this software works really, really good on a machine, on big boxes of machines. And we go around, we try to sell this from place to place, and we're like running in, we sell some deals, but then we realize that we just don't have the installed base. That means the number of people who are existing customers that we can pick up the phone and call and try to convince them on the software. But there's another person who would. So let's take my company, for example, Hewlett Packard Enterprise, maybe Dell, maybe IBM, maybe it's a company like DXC, for example, who owns billions of dollars worth of compute around the world. And we go to them and say, hey, look, this technology makes a lot of sense. Here's how it can help you. Here's where we're reaching our limits and scaling, but maybe it'd be interesting. You might be interested in talking about an acquisition. And that's kind of like a, somewhere between money back and successful exit low. That's pretty much this range where you go and you say, we're going to go into the market and we're going to see who might be able to acquire us. Successful exits, medium and high, these are really getting into IPO land, successful IPO lands, where you are going out and you're saying, you know what, this thing has done really well. We went into the market with angel funding. We raised $1 million and we were able to grow to $1 million in annual recurring revenue out of that. And then we were on track to 10 million. And so we took on another round of investments at $100 million valuation. And then we got to 100 million in ARR at a $10 billion valuation. And now we're going to series B and C and D. And now we're at 30 billion and $40 billion valuation. And now we're going to go initial public offering. And we went at IPO at say 25 or 30 billion. And the market just went nuts on it, and it's now a $100 billion company, right? That's the example of something like Snowflake, Databricks, Datadog type of companies. And those investors who came in there early, they are trying to plow in as much as they can back to this chart. They're trying, if they were here early, they are trying to go as far. I'm sorry, this slide. They're trying to pour money, more money in as they go along the way. So anyway, that's kind of like an example, a pro forma statement example of what a VC's structure looks like. And back on this one, so number of investments, so 5, 10, 15, 20, 25, 30. So 30 total investments, 10 million roughly is the average of each. But the total investment in each tranche is, they're going to try to limit. So this is, roughly $80 million is how much they're looking to write off out of the 300 million. And so they're going to basically hope that they can appropriately employ about 220 million of that capital that's going to return a $1.1 billion, that's 1,100 millions return, right? And that's strong. That's a 3x return on investment. And you're probably asking, well, how long does it take to get there? It really depends. These funds normally are going to be somewhere between 5 and 7 years. Sometimes they can be much longer, but typically about 5 to 7 years is what you're looking to from Series A through successful exit and getting your carry, your 20%. But if we did that, right? So along the way, we're getting how much? So 2% out of 300 million. That's $6 million a year to keep the lights on. Not bad. If we're a small shop, maybe there's like 5 of us or something like that, 3 or 5 of us partners and a couple of analysts and some admin staff. We exit with 800 million in profit. So 800 times 0.2 is going to be 160 million. So over the course of 5 years, we would have made $160 million, which is approximately $30 million, $32 million per year, right? So it's not nothing. It's not nothing, I guess. No, 160. Sorry, 32. Yeah, that's right. 32 million a year. I mean, we can live on that. All right. Oh, wrong slide. Okay. So the next thing we're gonna talk about here is what the cap table looks like. So a normal cap table, and this is super simplified. I'll show you an Excel spreadsheet on a next video. But let's say we come in, we say pre-money. Pre-money just basically means before the next round of investment comes in. So before you give me money, I value at, $1 million. Okay, and then I get that was my seed level, and then I bring in 250,000 in angel funding. All right, so 250K in angel funding, and that takes me to a post money of how much? Well, my original one plus 250K, 1.25 million. The team owns 80% and the angel gets 20%. Again, just kind of keep it simple. We talk about this 20% all the time. It's rough. It's a good rule of thumb. So then we go into Series A and we say, okay, well, the VC is going to want to have 20%, right? We know the VC is going to want to have 20% because every investor is going to want to grab roughly a 20% size of the pie. But the VC says, hey, look, I'm going to come in, I'm going to take $4 million and pour into you. I'm sorry, you've grown to a $4 million investment. I want to put $1 million of investment into you. So let's backtrack. So we built this up into a $1 million valuation. We went to an angel investor or some investors, and they gave us $250,000. Now we're $1.25 million. Then some time went by, and we raised our valuation up into a $4 million pre-VC, so pre-money on the VC valuation. And the VC comes in and gives us $1 million more. Now we're at 5. So 1.4 is 5. $5 million valuation, and for them to get their 20% now, and this all gets negotiated, right? It can be the founding team can negotiate and say we will take, the angel investor may, for example, say I won't dilute beyond 18% or whatever, and then the founder team might say, okay, well, we'll go to 62% so you can keep his 18% because it's dad or whatever. But the VCs are going to be pretty strong-willed about this. They're not going to come in and really give a whole lot of flexibility on how much capital they're willing to, how much ownership they're willing to give up. Because remember, in my previous talk, economics and power, there's two things that everyone's trying to grab. So their economics are 20%, or their power is 20% of the company. Their economics are a $1 million ad. Now some more time goes by. And maybe this could be as fast as like a year. Right? This can happen between a couple of years. It can happen as fast as a year, sometimes even faster. And now we've taken that $5 million total valuation. We took this $1 million and maybe we hired some sales reps and a couple of engineers, some product folks, maybe a marketing person. We did some ad campaigns, and we just scaled. Right? We just brought in another, say, $1 million worth of annual recurring revenue, and that has catapulted us to a $16 million valuation. And now we have another VC who comes in and says, hey, I want to give you $4 million. You know how much I want for it? Exactly, 20%. So they're going to also want their 20% stake in the company, and that's going to have cascading effects on everyone else. So the cascading effects basically come down to the founding team is chopping down to 51% ownership. The angel's now down to 13%. The VC is down to 16%, and the VC in Series B is going to have a little bit of a larger stake. So what's odd about that is if you think about, well, wait a minute, how does this guy now have 20% and these people who invested earlier have 16%? They own less of the company now. Well, two things. Number one, a lot of times VC2 will be the same people as VC1, or at least VC1 will have a significant portion of VC2. They might be leading that round, for example. They might be leading the Series B rounds. Series A may be leading Series B. The other thing is, again, smaller piece of the pie, but the pie's getting bigger. So if you look at, do the simple math, pull up. I don't think you can see my spreadsheet over here. So I'm gonna talk to you about it because I don't think you can see my spreadsheet, but let's just do the quick math. So actually, let me stop sharing this, and I will share here. All right, let's so let's see here. So we have our seed, Series A, Series B, and we had the 1 million. This is pre-invest, post, team, angel, VC1, VC2, right? Okay. So pre 250K. Let's do this in thousands. So 1,000 thousands is 1 million. 250. So this is going to be 1250, and this is going to be 80%. This is going to be 20%. And then we go over here as 4 million, and then we have another million that we're dropping into that gives us the 5 million. Forgive me for not actually doing, I can do this more properly, I guess, but we'll just copy down what we have on the slide. And then we have 20%, and then let's go put the 16 million, 4 million, and 20 million, 51%, 13%, 16%, 20%. Okay, now let's play this out. So team, actually, let's just do this. Easy. So we got a team, okay, a team here, and so first the team had 80% ownership of how much? 1.25, and the angel had 20% ownership of how much? Right. All right, and so that's pretty much makes sense, right? I mean, so we still have our 1,000 ownership, and now they have 250,000 ownership. That's just how the math works. So, okay, but now it gets a little bit more funky. I think I can just do, yeah. So let me show. So what we're doing here is now we say, okay, but 64%. Now the team in the next round, we diluted our ownership, right? Now we only have 64%, but it's a 5 million in valuation. That's at $3.2 million is now what our founding team is. Our ownership capacity is our VC. I mean, our angel guy is 800,000. Our VC is at 1,000, and that should all add up to yeah, 5,000. Good. So the math checks. And then we'll do it again. Take that. Make sure it's good. Make sure it's good. Make sure it's good. And then we got to take this one 20%. Of our post, or let's make these into something that's a little bit easier to read. Oops, not that way, this way. One more. All right. Excuse me, I'm not feeling super well. Maybe let's just put like a little line or something underneath it. I'm not used to using. All right, it doesn't matter. All right. So the point is, now you can see, well, the team, how much are they making? How much are they coming out of this with? Well, let's do something again. Let's take our these guys and on the second round, they are basically coming out with 3.2 divided by 1,000. So they have a 3.2x return on their investment, and then by the end, they have made a 10.2x return on their original valuation. All right, and we can do the same thing over here. That should be 0. Good. Okay, so I'll make sure that I didn't do something wrong. So the founding team, the founding team is getting 10x return on their investment. The angel made a 3.2x return on their investment, and by the first round, this was round, let's call it Series A, Series B, and then again Series A and Series B. All right. So by Series B, though, they only had a 3.25% return. Oh, I did that wrong. Equals. Sucks to be them. Yeah, 10.4 return on their investment. And then let me show. Yeah. So these folks came in and they dropped in $1 million into the fund, and they are basically walking away now on the Series B valuation side with on that $20 million valuation with $3.2 million worth of overall equity. So anyway, long story short is these are the multiples returns. So we'll call this return multiples, like we looked at earlier. And this is what's in it for you, right? So this is what's in it for you if you are the if you're the founding team or the angel. And the whole point here is that as you are over here is super high risk, and now as you get over here is lower risk. Because the thing is, when it's early on, right? When it's early on, over here it's like it's an idea. Here it's like now it's an idea that's backed up by some money and some people who believe in you. Now it's backed up by some money and people who believe in you, and more money and people who can actually help you shake things up. And now you're shaking things up, and it's backed by people who are going to help you scale further into the market. So as you further move from left to right, the overall risk lowers, and therefore the reward is also going to lower. So it is great if you're able to get early on, but it is also a reality that early on there's a lot of money to be lost. So let's now stop sharing there. Let's go back over to our other thing, and I'm at 34 minutes, and I will try to skip through the final slides and get this out to you. So back over to the cap table. All right, that's that. Look at my calendar really quick because I feel like I might be late for a call. No, we're good. Okay. This is a vacation holiday in the U.S. Like most of my team is on vacation this week. Just the folks I work with in Europe are not. All right, coffee. Oh, it's cold. I need the caffeine. All right. So capital intensive improvement. Okay, so entrepreneurial finance framework. What we're saying here with this is to say that the amount of capital that's required versus how crazy cool new the idea is. Now, you could have something that's not really crazy cool. It's not super novel, it's not super new, but it could cost a lot of money. Take a pause for a second and just think, what kind of example would that be? It could be shipping industry, building oil pipelines. It could be infrastructure, really anything infrastructure based. These are not necessarily venture capitalists are going to go and invest in those. You could find strategic investors, governments to commercial banks, sometimes private equity shops, sometimes SPACs. So sometimes I have a friend who just rang the bell on the New York Stock Exchange by launching his own SPAC to go out and buy up these types of infrastructure projects. So these require a lot of money, but there's nothing really sexy about them. And a lot of times the only reason why people get into those is because they have some unique knowledge of that business, that sector, something that's going to help them be able to get a higher return than other people who would. And then you have other things that are also kind of boring. And by boring, I mean just not really new, but there isn't a lot of cash. So this would be, we want to start up a coffee shop or a food truck, or I want to launch an e-bike services company. I want to, really any of those kind of smaller businesses, right? Where you say, okay, well, I can use some of my personal credit. That means I go to the bank and I say, here's my income statement for my job. I have this much cash in my savings. Here's my business plan. Here is me as a person. I would like for you to give me some money. And then they basically give you a business loan to go out and do something. And that could be buying an existing company as well as launching something brand new. But those are all on the left ends of the novelty spectrum. And typically what venture capital is looking for is something on the other end of the spectrum. So the things that are on the other end of the spectrum, let's look at, this is, actually before we get down to the bottom right, let's look at the top right. So capital intensive new technologies. It says here, hard to fund without government support. So what could be an example of something like that? I'll give you an example. What about launching a spaceship into orbit? Now, Blue Origin, SpaceX, etc. But if you wanted to go and launch something like, if you wanted to go go send someone to or a spaceship to Mars and you try to colonize that or find minerals to bring back, you would typically need something like a governmental sponsorship, not because you necessarily need, just because you need the licensing and the backing for it, but financially, it's just going to be a monumental amount of money. And most banks are just not going to touch it. So governments will touch things like that because there's strategic interest for them to do it. A better example is probably something like laying fiber optic cables across the ocean to be able to allow communications between, say, North America and Europe. Another really good example is the Hyperloop. So this is the thing that Elon Musk did, which was, or is doing, which is basically going to be this magnetic tube that will shoot you from Los Angeles to LA faster than a plane could go, and safer, and all these kind of cool things. Tons of money it will take to do that, and there's no way you can do it without getting massive amounts of government partnerships. Government wants it because increases transportability, it lowers environmental costs, it just all kinds of reasons why government might be involved in that. So typically areas like that, no one's going to touch it, right? You might want to get involved in it. It's super cool, but it's not something that necessarily like a VC is going to want to be involved in. However, now we get down to the sweet spot. So new technologies that are going to solve new problems. So you could have, for example, on the small business end of the spectrum, say the e-bike company, and you might say, okay, well, I can't necessarily go start up a new e-bike motor because that would be capital intensive, and there's Bosch who already is doing some of that, and KTM and others. But maybe what I can do is I can work with the data that's around it, and I can figure out how to optimize those, or I can work with a GPS provider, and I can come up with a really cool new app where I click this on the front of my e-bike, and it predicts where people are. It knows where other people who are riding e-bikes are. And it knows where different stopping locations are, and it can guide me to an area where there's like a picnic bench where there's a low likelihood that someone else will be arriving there at the same time. Or I can click on there and I can say reserved for me, right? So that way, if I'm riding in the woods, I would see someone else has reserved a bench, and I'm not going to ride over there because I know that they're going to pull up and they're probably going to get angry with me. I'm totally making this up as I go, but something like that. My point is to just illustrate the transition from a small business to a new technology in an area. And this is the type of thing where angel investors and venture capital care the most about. The area where I work a lot in is in data and overall kind of everything as a service. So software as a service, platform as a service, infrastructure as a service, everything as a service, specifically in the technology world. And there are tons and tons and tons of examples for things that, to be quite frank, you probably just never even heard of, but there are problems that are big enough of a problem, like it's a big enough of a pain in the ass for people that they're willing to spend millions and millions and millions of dollars to get that solved or make their life easier. Because if they are able to make that easier, then they are able to scale their operations so much more quickly. They're able to work on things that they couldn't work on yesterday, and so the juice is worth the squeeze, as we say. And areas like that are what all the investors are trying to find. And the more that they work in this area, they start to know what those pain points are. They start to know who's working on them. They start to know what keeps people from succeeding in them. And all that kind of feeds together. It makes them better and better and better. So it's a virtuous cycle if you're a good VC and you get in this, because you learn a lot. And the more you learn, the more you connect with people, the more success you have, and the more you just get better. That being said, it creates its own little moats around kind of getting in, because then if you are not plugged into that, it can be really challenging to jump in and triangulate all those data points and move forward. Okay, not going to spend a ton of time here, but you know, just the bottom line is to show you the financing options that are available for a high growth venture life cycle. So venture capital, seed funds, and traditional VC are typically going to be involved all the way from the seed stage up through around the third round. So Series A, B, and C. So around here to Series D even is typically where VCs are going to play. They don't really care about expanding existing businesses that are growing super large. At that point, you know, they're going to go back and look for the next things that they can kind of work through, because this is their sweet spot. This is what they know. These are more like public equity funds, so hedge funds and things like that, where they say, Private equity shops are going to come in and look at how they can expand and how they can do a management buyout, LBO type stuff. This is really private equity and hedge fund area. And over here is really the venture capital and angel side of things. There's also a lot of bootstrapping. Bootstrapping is where you just use your own money, your credit cards, savings, going into your retirement account, taking loans out against that, talking to your friends and family. Venture debt is something unique. I had never even heard of venture debt until a friend of mine got venture debt for one of his startups. Where basically he went to an entity here in Germany and they gave him like 500,000 euros that could be converted later into a 10% ownership, which is kind of like a mezzanine structure in a way. It's basically convertible debt. And you see convertible structures all the time, but most of those are going to be more from like going from preferred to common stocks. So preferred, they'll buy and invest in a company, as we talked about in another class, right? That they will invest with preferred stock, but they want that to be able to be converted into common stock so that they can be protected in the early stages when they may have to liquidate, but they also have protected their upside by making sure that they have unlimited growth potential. We talked a lot about really everything on this slide in previous classes, so I'm not gonna waste too much more of your time on there. Convertible, but speaking of convertible, again, not to hammer the point home too hard, but here the point is that look, as you're continuing to your investment, you're looking at the exit, right? So your exit value to the VC. So if the VC investor capital today, there's a break-even point, and we saw that earlier up here, right? So money back, right? Their money back portion of how much capital they have to be able to get back, and everything before that point in this Series A is a loss to the VC. In the B section, it's kind of like, well, this is post money. We put some money into companies, and now we're expecting for that portfolio to grow. And everything again below the red line, VC loses everything above the red line. VC wins, and that just takes a combination of time and success as they kind of continue to grow, and VCs continue to invest more. They have more later round stages of funding, and the valuation model goes up and up and up, hopefully, and the VC percentage of ownership is going to continue going up as well, as long as the VC is exercising a lot of the terms and conditions of their initial investment, where they basically have the chance to come in and buy out later. Maybe sometimes a founder might say, hey, look, I want to take $4 million out of my ownership because I need to get some money to pay off my house, and I just take care of my family, and I'm okay with taking $4 million now instead of $40 million in 5 years. And so the VC may say, hey, I'll help you out. I'll take all of that because I'm happy to make 40 million or the 36 million extra over the next few years, because they have different capital requirements. And so there's different ways that the VCs can increase their percentage of ownership outside of just the follow-on rounds of funding. And then the point here is entrepreneurship percentage. It's always it's a tug and pull, right? Of how much is the entrepreneur getting and how much is the VC getting. But if it's done correctly, as it should in the cap table examples, everybody walks away winning. It shouldn't be that the VCs are getting a 10x return and the entrepreneur is getting like a 1.1x return. And then finally, you can have a ton of different angel investors. You can have, I read recently that there was something like around, you can have as many as 10 to 20. So I think on here it says up to have 15 plus, but common, like average number could be 10 to 20. And man, think about that. That is a lot of people. There's a lot of different people who are going to ask questions about what you're doing. A lot of people to answer to. So you want to choose wisely who those 15 are. So you definitely look for people who have experience in your industry, experience in functionally in what you're trying to do. So for example, if you were to come to me, I can talk to you about the technology space, specifically around enterprise level data and software as a service. Functionally, I can talk to you about sales, marketing, and product alignment and growth. Those are the things I can work on, as well as maybe a little bit of the community building around some of this. So all around growing it. And so you would find people like that who could come in and who could help augment and complement. So one thing, for example, that Justin would bring to the table is if you're starting out of Germany, you're wanting to grow into France, and then you're wanting to grow into Italy, and you're wanting to grow into Eastern Bloc countries, and you're wanting to grow in the US, right? Having points of contact in each of those areas who I have personal connections with, who will answer the phone when I call, and who will, as long as you have your shit together, listen to your pitch, and possibly partner up with you. And those are kind of what you're looking for in angel investors. Not trying to convince you to be an angel, bring me as an angel investor. So, and then finally, I would say, I think, this whole concept of solopreneur, and I only threw this slide in because one of you had asked about, kind of doing things on your own, and I just want to emphasize a point here that we're at 48 minutes, so less than an hour. I said 30 minutes, we get less than an hour. So think about, there's a thing called Solopreneurs, and there's a book, a really great book actually. If you type in solopreneur millionaires or 7-figure solopreneurs or something like that, you'll find it. You can download it on Audible. It's a pretty good listen. But the bottom line is that there are people who are wildly successful, people who make sometimes much more than 1 million per year as solopreneurs. They don't want to grow something to $1 billion business. They want to have a lifestyle, and their lifestyle, most people can fulfill their lifestyle with $1 million a year. I certainly could, and I'm nowhere near that. So solopreneurs. So what is the examples though to consider about this are thinking about what's the complexity level and what's the scalability. So the complexity can be a double-edged sword. It can be a challenge for you to get started. So if something is as complex as, for example, like we were saying earlier, the Hyperloop, where Elon Musk is going to shoot people through a tunnel from Los Angeles to San Francisco, probably not going to be able to do that as a solopreneur. However, if you are a solopreneur who is a freelance coder on an obscure programming language that solves a very complex problem, that could be something that's very complex, but is a benefit for you, right? So it keeps others from being able to jump in because it's very hard to do. Very good, however, for you in your business. However, there's always going to be a point of scalability. There's only so much you as an individual can do. So then the question is, well, how can you do more? So let's just take 3 examples on the very solo side, and you take this and go home with your notepad and just kind of like write out some ideas and think about this for yourself. You can have, starting out with selling individual units, maybe water bottles, maybe stickers that go on water bottles, pens, whatever the case is, right? You have things that you're selling individually. Maybe a good example is the coffee shop. And another, that's on the very low end scalability section. There's only so much I can individually sell. I can go around door to door trying to sell bottles of water, but that's not going to be such a great idea. So what I can do is drop ship. I can make arrangements, for example, with Amazon, and I can go to a website, for example, called Alibaba, and maybe I find a distributor who can sell me really, really cheap water bottles, and they will brand it for me. And I go and I have a website for that. And now that website is used to show it to you. You go to the website and you like it and you click to buy it. And then maybe I use Amazon as the back end, or maybe I use Shopify as the back end or something like that. And basically now I'll go from me selling individuals to me selling a bunch. And that can all be done by me, right? So there's, you find something in the market where maybe other people aren't doing, and you're able to do that. And the challenge is you have to find something very, very niche, very specific that a lot of people aren't doing. And then finding a way to do that where the economics of it, so the per unit economics of it, per unit economics means like you're not going to lose every time you do it. Those are positive. That's the challenge. Per hour consulting. So maybe I come and consult to you and I help you out with, say, your marketing, your digital marketing plan, because you don't have a CMO. And maybe I want to come in and I want to be basically your chief marketing officer, but on the side, right? Because you don't want to bring me on staff because I'm expensive. But you hire me per hour consulting. So maybe you say, hey, Justin, I can bring you on, but I can't pay you more than $2,000 a day. I'm like, cool, that's no big deal. Let's do that, and we'll do it on a per booking basis, like minimum 1 month or something like that. All right, so that's cool. So or per quarter is usually how people try to do stuff like that. So that's good. But again, there's only so much I can do. So there's only roughly 250 days a year that I can do that. So there's only 250 days times 2,000 is not bad, right? It's going to make $500,000 a year. But there's a bigger way. So what about if I have a distributed design team and I go out and I'm talking to a lot of people, and I have people who are creating content, creating videos, websites, and a lot of things that I can go back and I can show to people really quickly, and I'm not having to go back and build everything from scratch. So my $2,000 a day, maybe I can span that out over a number of different projects. So there's limited face time that you would have with me for my $2,000 per day, but I have a whole bunch of people who I'm paying behind the scenes to do a lot of stuff for me as a part of that $2,000 a day that you're paying me. So now suddenly I'm getting a lot more than $2,000 a day. So that's one example of scaling that. Same thing as teaching class. So I've been talking to you for 53 minutes and 46 seconds. Okay. If I was getting paid for 1 hour of doing this, which I am, actually I'm not, I'm giving the money away. I do this for a write-off. I don't actually get paid. I would get paid whatever the university pays a lecturer to do this. But then it's like, well, then again, there's only so many hours in a year. So how could I do that in a way that would reach more people? Well, I could go to a platform like Udemy. Udemy would take, say, 30% of whatever. I would charge you money, you would pay the money, and I would get 30% of it. Or maybe I go to YouTube and I upload the videos and I give them away for free. But then I get sponsorships and I say, hey, this video is brought to you by water bottles, or they're brought to you by stickers, or they're brought to you by paddleboard company, or whatever. And paddleboard company, sticker company, water bottle company, those people pay me to use their products in the videos as a sponsor or something like that. And sometimes I might say, hit that, click the link below if you want to try this. A lot of people who do things like where they say, I'm using this camera, this setup. You click down below, you can buy that. They make that. Then you just click through. There's a form of revenue that you can make out of that. Blogging is similar. So write once, read a million times. And the more people who read, the more people who you're going to be able to get ad impressions. And so the point is that, think about this on your own. This is a short answer to the question that yes, you can do solopreneurship. There are people who make millions, much more than 1 million per year as solopreneurs because they have found some niche area where they are the unique person who has the insight, the access, and something about them that is just irreplaceable, at least for that moment in time. And they have found a way to do that and execute on it and be very successful. That is a very, very challenging thing to do, but is, I would imagine, a very, very cool thing to do. I have a few friends who are solopreneurs, most of them in the consulting side of the world, as well as some that have a couple of side businesses, and they seem to enjoy their life very, very much. So consider that. That's what you should do. Write down your notepad, your complexity and scalability, and just kind of think about some ideas. What are some things that are from low to high complexities that you know of today, or that you think you could grow into rapidly? And how would you do that on your own now? And how could you potentially scale that? And just consider it. I mean, think about it as an option, as something else you can do, with your life, with your career. Okay, with that being said, we have been at it for almost 1 hour, and so I wanted to we didn't get a chance to do that because my daughter was sick with COVID last week and the week before. There was another illness, and so yeah, I hope you get something out of this. Write me a note with any questions you have, and if I don't hear back from you, then we'll see each other in the next class. Thanks. Have a great day.